Now in this class, we're looking at some principles or some assumptions that guide the way we record transactions or report activities of a business organization. We've been preparing accounts, okay, but there are some principles or assumptions that help us, take those steps of capturing transactions before reporting them. So in this class, we're going to be looking at accounting concepts and conventions. Now, generally, there are impressions, there are ideologies, there are perceptions, okay, principles, okay, and even assumptions, okay, that guide the way we record and report the activities of an organization, okay. Now, those are basic assumptions that guides or help us or that leads to recording transactions or economic activities in a particular way is what we refer to as accounting concepts and conventions. So basically, in order to have a fair and justifiable interpretation of the activities, okay, of the organization, we apply these basic concepts and conventions. So here we have what we call the entity concept. Entity here means separating the business from the owner. So where we are recording transactions of a business, we always try as much as we can to separate those resources that belong to the business from those resources that belong to the owner. So the owner's property or the owner's resources are seen as the owner's resources and not the business resources. The business resources are seen as the business resources and not the owner's resources. That's why where the owner makes some withdrawals, we put it in the drawings account or we put it in the director's current account. So basically that is an application of the entity concept. So I will know that the business is operating profitably, okay, without the intervention of the owner, okay, taking the resources and then using it personally. So basically what we do is to try and establish the fact that when the owner takes out items for himself, it is expected that is returned back to the business, okay, or somehow we'll find a way to take it out of his own allowance from the business. So basically entity concept is saying that business is business, owner is owner. Business is not the owner, owner is not the business. Business is different from the owner, owner is different from the business. So when the owner brings in money into the business, it is seen as an investment into the business, which is more like equity or capital, okay. And then we'll say that the business is owing the owner of the business, that amount has been invested. So we must be able to differentiate what belongs to the owner and what belongs to the business. This is what entity concept tries to establish. Going concern, what we're trying to say here is that it is expected that a business organization should continue to exist for a very long period of time into the foreseeable future. You should be able to survive, okay, indefinitely. That is what we call going concern. So there are various bases for accounting under the going concern. So we're going to be looking at those bases now. So we have the cash basis. What's the cash basis saying? It is saying that you only say you have made an income when you have received the cash, and you only say you have incurred an expense when you have paid for the expense. So if you have not received the cash, okay, you don't say that you have earned an income. If you have not paid the cash, you don't say that you have incurred an expense. That's what we mean by cash basis. The next one is accrual basis. It's saying that you recognize your income when you have earned it, not necessarily when you receive the cash. Okay, if you have rendered the service and the customer or the client has established that yes, it has been rendered, then you have earned that income. Okay, the same thing goes for expenses. If you have incurred it, then you have to recognize it, not necessarily when you pay. So you can say, okay, I'm renting this place, but I'll pay in 2 months' time. So as it is, you have incurred it, okay, but you're yet to pay. So that does not mean that it is no more an expense, okay. So in accrual basis, once you incur it, okay, and then it becomes an expense. Once you earn it, it becomes an income, not necessarily when you pay or when you receive the cash. So the next basis under the going concern base of accounting is what we call the adjusted cash basis. So here you're combining accruals and what cash. Okay, for revenue, okay, you only recognize the income when you receive the cash, but for expenses you recognize it when you incur. Okay, so that is what we call adjusted cash basis or modified cash basis. Okay, your revenue or income is recognized when cash is received, but your expenses is recognized when you incur them, not when you make the payment. So we have the next one, adjusted accrual basis. Adjusted accrual basis is saying that you use the cash basis to capture your transaction, but you make some adjustments to make it appear like an adjusted, to make it appear like an accrual basis of reporting. So basically, you are applying cash basis, but you will use journals, okay, to make some adjustments and make it look like accrual basis. So let's continue with the concept and convention. We've just talked about going concern, and then we looked at accounting under the going concern concept of accounting. So here we have what we call money measurement. From the word money, you can say money is a medium of exchange, right? So basically, if you cannot measure a transaction in terms of money, then it means that it has no value in recording. So basically, if there's a transaction and there's no money value, you cannot say it is valued or it is worth 10 million, or it is worth 1 million. Okay, it can be assumed that that transaction has no value because there's no money, there's no way you can measure that transaction with money. So what money measurement is saying is that for you to recognize a transaction, you must be able to measure it in terms of money. Okay, so if you are into a dialogue, a business dialogue, and then there's no money measurement, there's no way you can value that dialogue in terms of money, then there's no need recording it. You are entering into a transaction with a friend or with a business partner, and then at the end of the day, okay, you can't really say that it was 1 naira worth of business discussion or 2 naira worth of business discussion. So if you cannot attach money to value it, then you cannot capture it. So that's what this money measurement is saying. The activities, the economic activities, the transactions of a business organization must be able to be measured in terms of money. So common denominator, okay, it's 20 million, it's 30 million, it's 40 million naira, it's $50 million. We must be able to establish the money measurement of that transaction. Otherwise, there will be no way to capture it in the records or the books of the organization. Periodicity, okay, what we are saying here is that there is a particular period for reporting the activities of the organization from time to time. It is defined. So this concept suggests 12 months, which is 1 year. That's per annum. So basically, business organizations report their activities at the end of the year. Okay. So what we're not saying is that it is not possible for you as an organization to break it down. You can do monthly review, quarterly review, mid-year review, or yearly review. But what this concept is saying is that there must be a defined period, okay, for which business activities are reported. Is that not so? So if it is 1 year, fine. Then if you want to say, okay, we'll do 1 month, we do every 3 months, we also do every 6 months, then we'll do 1 year, that's acceptable. So that is also in compliance with the periodicity concept that says that there must be a defined period covering the activities of the organization from time to time. So there must be a period. Okay, so here we're looking at the prudent concept. Prudent concept here is saying that we must take reasonable steps to ensure that profit is not overstated, okay, or earnings is not overstated. So what I'm trying to say is that when you're reporting or capturing your transactions, okay, reasonable steps should be taken to avoid misleading users, okay, by reporting high profit that is not real. So you should be able to make necessary adjustments to accommodate your revenue, okay, prudently. Okay, you don't record earnings, okay, where you cannot reasonably establish that it has been earned. So basically, you have to be prudent in capturing expenditures as well, and then you have to be prudent in capturing what revenues. So basically, take necessary steps to ensure that profit is not what overstated. So this concept is called the prudent concept. Now, this is consistency. So what we're saying is that if you are adopting a particular method or a particular policy for treating an item, you should be able to what stick to that method from time to time. You don't change from one method this year and then use another method next year. It is contrary to the consistency approach of reporting. So what we're saying is that you, as an accountant or as a finance professional, you must understand that where a method is adopted, you should use that method from time to time, except of course maybe there is a reason beyond your control that you cannot avoid, that will not enable you, that will not force you to change your method. But basically, you should use your method over a long period of time. As a matter of fact, from time to time, indefinitely. Be consistent with your method of reporting or method of treating an item. For instance, depreciation. Depreciation, we have various methods: straight line method, reducing balance method, evaluation, some of the year digit, unit of output method. So whatever method you are adopting for a particular item or a particular asset, it is expected that you continue with that method over a long period of time. So you do not just switch, use this method today for this asset, then the next year you use another method. Is against this concept. Now, this concept is called the matching concept. Matching concept. What we're saying is that you should be able to capture and report your activities prudently, okay, with your costs reported against your your earnings. So you want to be able to fairly represent your profit. What are we saying? Remember, if you're preparing your income account or income and expenditure account, what do? You match your income, which are similar items for the year, against your expenses, which are also similar items for the year. So this will give you the bottom line of the business. So what we're saying is that you should always apply the matching concept, okay, to fairly represent the profit or loss of the organization. So the matching concept basically is helping us compare our earnings against our expenditures for the period. Prudently captured cost against prudently captured earnings. This is materiality concept. What we mean by materiality is the significance of an item. Okay, what we are saying is if you omit an item from the report, will it affect the decision of the users significantly? If it will, then that item is called a material item. If it will not, then it is immaterial. So what we are saying is that you should be able to ensure that significant items that will affect the representation of the activities of the business, okay, are stated and explained clearly without omission. Okay, so what is significant for a business might not be significant for the next business. Okay, so if you look at a very big organization, okay, they might tell you that if an item is between maybe 10,000 and 50,000, you can write it off immediately. That's an expense. Don't try to break it and write it off gradually. But some organization will tell you that if an item is between say 100 naira and 10 naira or 1,000, you can write off. Anything above that, you make sure you detail the write-off. So you can see that for some organization, an item can be significant. So if you omit it, it's not material. Okay, but some organization, that item is insignificant. Okay, so what we're saying is that for any organization that has an item to be insignificant, its omission is not material. But for an organization, okay, that have an item to be significant, Okay, its omission is what? Material. So an item is deemed to be material where the omission of that item will affect business decision of the users. To ensure that you record items in agreement with the materiality concept. Okay, here we have historical concept. What we're saying is that what activities that you report in a particular period is basically what has happened. So it's more of what? Past event. So if you're reporting by the end of December, let's say 31st December 2019, what you're reporting is the activities between January and what? December. So these are events that have happened. So you are reporting based on already happened, already occurred, or event that have already what? Happened. So that is why we have what we call source document. So what I'm saying is that every transaction must have an origination. So you have originating document or source document to back up the transaction. Okay, so that where you are trying to trace a particular item, you have a source document to back it up because the transaction has already happened. It is historical, but if you must check, you have to check through what? A source document. So this concept is what is backing the essence or the reason why accountants will always require for documentary evidences before treating a payment or before concluding a transaction, because they have to abide or agree or be guided or decide or treat the transaction based on the historical concept. So here we have objectivity. Okay, what we're saying is that you should ensure that the activities of the organization, they are reported without bias, without partiality. Sometimes you have business owners wanting to intervene in the way activities are reported. This is against the concept of objectivity. Okay, so what we are expected as accountants is to ensure that organizational activities or economic activities are reported without bias. Management of business organizations can be guilty of objectivity concept. Sometimes they want you to report it in a particular way, okay, which does not convey the right information about the business. That is, somehow the information is not exactly what it is, not 100% correct. So because they want to pass a particular impression, they want you to report it in a particular way. That might be going against the objectivity concept that says that business activities should be reported objectively or represented objectively without partiality. You cannot be favoring the management of the business against the external users. Okay, you can as well not be favoring the external users against the management of the business. So we must ensure that what has been reported is objectively represented. Okay, you are not trying to be partial to any of the users. So no manipulation, basically. That's what the objectivity concept is saying. You're not trying to favor anybody. Here we have what we call the realization concept. Realization concept. What we're saying is that you must be able to establish the fact that your client has accepted liability for the debt before you recognize revenue. Okay, to some extent, to a reasonable extent, you have been able to establish that yes, this person is owing us. Okay, you don't just say that because you have concluded transaction and because the person has accepted to be involved in the transaction and you have not supplied the goods to the person, you will now assume that you have realized that income. No. If you have concluded transaction, that means that the person accepted to be part of the transaction or the deal. And then if you have not rendered the service completely, you cannot assume that you have realized the income completely. If you have not supplied the product and the person has acknowledged delivery, you cannot assume that you have realized that sales completely. So you must ensure that you recognize the income or the revenue or the earnings when the customer or the client or the individual that is receiving the service has accepted liability for the exchange. Now here we are trying to look at transactions from different perspectives, from the economic reality perspective and from the legality perspective. So sometimes you have transactions, okay, where you can interpret it from the legal angle and you can also interpret it from the economic angle. So where you have that sort of instance, you don't rely only on the legal form. You rely more on the reality, the financial essence, the economic reality of that transaction. Okay, so you do not look at transactions merely by their legal appearance. You should also look at it from the reality economically or financially. The reality on ground financially should help you to make some adjustment. Let's look at a debtor owing. You sold goods on credit to a debtor. Legally the person is binding, okay? He's supposed to pay. Now what happens if the person is delaying? Person has refused to pay over a long period of time. Legally that person is still owing, okay? But reporting that debt in the business continually is giving an impression. If you do not find a way to explain that this debt, okay, is getting close to being bad, or is even giving us the bad debt signal. If a debtor is owing you, a debtor that's supposed to pay you in 3 months is owing you for 6, 7, 8, 9 months. Recovering that debt is very challenging. That is the economic reality. But the legal implication is that this person is owing you. So you can take the person to court. You can take legal actions against that person to get that money back. But if you have to look at the economic reality, okay, that debt is eroding the profit of the business from financial perspective, because if the person that does not pay is holding on to the investment in the product that you sold to me, also holding on to the profit. And then if you keep reporting that debt, the profit you are reporting might be overstated if you do not make proper provisions to gradually write off the debt that is in the book, owing to the economic reality, the financial reality that this person is not paying as at when due. So 3 months, 6 months, 9 months, 1 year, payment is not coming and still report that the person is owing you. There's nothing wrong with that legally because he's owing you. That's the legal appearance. But the economic reality is that this debt is getting bad. So you have to raise the necessary journals to accommodate or provide for your bad debt so that you can balance both perspectives. So what we're saying is that as an accountant, you should be able to look at a transaction from the economic reality or the financial substance or essence of the transactions rather than just concentrating on the legal appearance of the transaction. In this class, we've been able to look at the principles, the assumptions, okay, the perceptions guiding the way transactions, activities of an organization is reported. Okay, we're able to look at the concepts, entity, going concern, another going concern. We looked at the basis for recording or accounting for the activities of the organization under going concern. Cash basis, accrual basis, modified or adjusted cash basis, modified or adjusted accrual basis. We looked at other concept, materiality, objectivity. Okay, we looked at substance over form. We looked at various other ones, prudence concept. Okay, we looked at the matching concept. Okay, so basically that is what we have looked at in this class. So you can go through it again, and then if you have questions, you can reach me on 08136506356 or send me an email, jeremiah.dosu@gmail.com. I have a Facebook page, jeremiah@dosu-jad, okay, where you can get updates when we publish topics from time to time. I have my WhatsApp number also displayed on the page, so you can chat me up so we can discuss whatever topic you're having issues with. We have other topics as well on the Jados Consulting YouTube page. Pick any topic you like, go through it. If you have issues, let me know. We can always discuss it and exchange knowledge. Thank you.